So no, there's nothing wrong with value investing, but for me, I think it reached a point where it was no longer satisfying intellectually to just sit there and constantly analyze businesses. Abstractly, although I did enjoy learning about different industries. And that's another very important thing. You know, value investors need to be versatile enough to learn about the economy itself. And one of the issues I had with the method intellectually, or the school of value investing intellectually, and some of the mentors that I had, was they genuinely believed that they didn't need to care about the economy at all. Their job was just to look at individual stocks and construct a portfolio of individual stocks.
So they had detailed focal knowledge.
Yeah, and there used to be these adages in the community all the time. I remember even as a young kid, you know, that nobody can understand macroeconomics. You know, that stuff is just a fool's errand, and there, you know, you can't actually, but importantly, you can't actually value a commodity, because a commodity has no balance sheet. And they were kind of starting to...
How do you distinguish a commodity from a stock or another financial asset?
Well, commodity is something that's physical. So its possessor is using it as an input. So if you buy wheat, you know, you might buy it electronically, then you take delivery of it and you use it to make flour, to produce bread.
So we think of those as raw materials.
Yeah,
in some sense. They're natural resources.
That's right. You're not buying it to sell it onwards. You're buying it to consume it. Whereas
so it's an input into another process
right.
that generates value from those initial raw
That's right.
materials.
In fact, it's the fundamental input, as I'm sure we'll get into. A stock is basically a contract, you know, a note, a piece of paper that says that you're entitled to a share of a corporation. And corporations themselves are these interesting entities which are, you know, relatively new in the history of humanity, joint stock companies. The idea before that was that you would normally create a partnership, pool capital. Then when you died, your other partners would have to buy you out. But with stocks, you've created these entities that essentially live on forever with just the shares changing hands.
Right, a more abstract form of ownership.
But what that
allows it to be more distributed, allows risk to be more distributed.
That's right.
Zoom allows people to diversify more easily.
That's right. But what that achieves is a kind of illusion where once a stock is traded on a public exchange and it has shares slushing around every single day, investors begin to impart a sense of timelessness or entropy resistance to a share of stock.
Right, like it's a thing.
Yeah, you can't conceive that Apple will not be around in 100 years.
Right, well, and it ties
out
into our psychology very interestingly, because if you plot a stock and you see it going up, well, if you see a physical entity going up, and it's still moving at a pretty decent rate, you assume it's going to continue to go up. It's very difficult to shake that when you're looking at a stock chart, because you have this built-in embodied proclivity to assume things like inertia. It's going down very rapidly, and things going down rapidly tend to go down rapidly to continue that. And there's no reason really to assume that that's the case at all with a stock, because, well, if you could, then you could predict the stock, and then of course you could make a lot of money.
Yeah, but there's actually an even greater problem, which is a historical fact that if you stretch time, none of these stocks ever survive. So when Charles...
they hit zero at some point.
Well, they actually disappear. They go bankrupt or they get reorganized. And so when Charles Dow, who worked at the Wall Street Journal, at the Dow Jones Company in the 19th century, formulated the initial Dow index of 30 companies. It's the same Dow index you have today. The index is the same. However, there is not one constituent. I think U.S. Steel is no longer in the Dow. Yeah, there's not one constituent in the Dow today from 130 years ago.
Right, so you're trying to measure something whose constituent elements are transforming constantly.
That's right. Yeah, but the double illusion there is that the index value itself becomes an object,
right?
You know, it becomes a security in and of itself. So people like always. I mean, you know, some of the greatest economic thinkers, Nobel laureates, will make this error, but the whole industry makes this error. And what they do is they'll say the value of the index has gone up this much over this many years, but the problem is that the index from 100 years ago was an entirely different group of stocks. And every time you need to get rid of some stocks, there's costs associated with it.